Investing in the United States is a powerful tool for building wealth, but it requires a disciplined approach similar to running a successful business. Think of each dollar you invest as an employee working towards growing your wealth. Every decision you make should be carefully considered, weighing both risks and opportunities, just as a business owner would do when allocating resources. Developing an investment plan. A well-crafted investment plan is essential. In the U.S., this plan should include clear financial goals. Short-term, this could include saving for an emergency fund, buying a car, or planning a vacation. Medium-term, examples might be saving for a down payment on a home or funding college tuition. Long-term, retirement planning or leaving a financial legacy for future generations. Having specific goals helps determine the appropriate types of investments. For example, short-term goals might be best served by low-risk investments, while long-term goals can handle more volatility for potentially higher returns. Risk tolerance. Your ability to handle market fluctuations is crucial in choosing investments. Those with a higher risk tolerance might allocate more to stocks, while more conservative investors might prefer bonds or certificates of deposit (CDs). Diversification. Diversification is key to reducing risk. This means spreading investments across various asset classes, such as U.S. stocks, international stocks, bonds, and possibly real estate or alternative assets like commodities or digital currencies. Review and adjust. Regularly reviewing your portfolio is vital. Changes in the economy, your personal life, or the market may necessitate adjustments to your investment strategy. For example, as you approach retirement, you might shift from growth-oriented investments to more conservative, income-generating assets. Practical example: imagine you're 30 years old and plan to retire at 65 with a portfolio of $1 million. You decide to invest $500 monthly in an index fund that averages 7% annual returns. Using a financial calculator, you'll find that after 35 years, your investments could grow to over $1 million. If you find that the market performs better or worse than expected, you can adjust your contributions or investment strategy accordingly. Advantages of paying off a mortgage early. Interest savings. By paying off your mortgage early, you save on interest payments. In the early years of a fixed-rate mortgage, most payments go toward interest. Reducing the principal balance sooner can save thousands of dollars over the life of the loan. Peace of mind. The emotional relief of being debt-free is significant for many. Once your mortgage is paid off, you own your home outright, free from the obligation of monthly payments. Increased cash flow. Without a mortgage payment, your monthly cash flow increases, providing more flexibility to save, invest, or spend on lifestyle improvements. Disadvantages of paying off a mortgage early. Opportunity cost. If your mortgage interest rate is low, you might earn a better return by investing the money elsewhere. For instance, if your mortgage has a 3% interest rate, but the stock market offers a 7% return, you could potentially grow your wealth faster by investing rather than paying off the mortgage early. Loss of liquidity. Money tied up in home equity is not easily accessible. If you face an emergency or need cash, it might be challenging to access these funds without taking out another loan. Tax considerations. In the U.S., mortgage interest is often tax-deductible, especially if you're itemizing deductions. Paying off your mortgage early could reduce your deductions and potentially increase your tax liability. Practical example. Consider you have $20,000 in savings. You could either use this to pay down your mortgage or invest it in an S&P 500 index fund. If your mortgage rate is 3%, paying it down would save you that interest. However, if the index fund returns 7%, investing might net you a higher overall return, even after taxes. The choice depends on your financial goals and risk tolerance. Building wealth. Creating and managing two funds. In the U.S., a strategic way to manage wealth is by creating two distinct funds. one for personal goals and another for growing your wealth. This approach allows you to enjoy your money while still building a secure financial future. The Dream Fund. This fund is reserved for goals that bring personal satisfaction, such as vacations, hobbies, or major life events like weddings or milestone celebrations. Strategies for managing the Dream Fund. Budgeting. Allocate a specific amount each year for your Dream Fund. This helps ensure that spending on personal goals doesn't compromise your long-term financial security. Low-risk investments. Since this fund is for short to medium-term goals, consider low-risk investments like high-yield savings accounts or U.S. Treasury bonds. Regular review. Periodically review and adjust your Dream Fund to match your evolving priorities and financial situation. The Wealth Building Fund. This fund is dedicated to investments aimed at generating long-term returns. It should be managed with discipline, reinvesting earnings to maximize growth. Strategies for managing the Wealth Building Fund. Reinvestment. To take advantage of compounding, reinvest all earnings from this fund, such as dividends or capital gains, into additional investments. Diversification. Ensure your wealth building fund is diversified across various asset classes, including U.S. stocks, bonds, real estate, and possibly international markets. Discipline. Resist the urge to dip into this fund for non-investment purposes. Its primary goal is to build your financial future. Practical example. Let's say you set aside $5,000 annually in your Dream Fund and $10,000 in your Wealth Building Fund. The Dream Fund might be invested in a short-term bond fund or a CD ladder to provide stability and some growth. The Wealth Building Fund, on the other hand, could be invested in a diversified portfolio of ETFs and individual stocks with the goal of maximizing returns over the next 20 to 30 years. Practical examples. Strategic negotiations. Negotiation is a crucial skill in the U.S., where the ability to secure better deals can significantly impact your financial well-being. Whether you're negotiating a car purchase, a salary, or a real estate deal, being informed and strategic can lead to substantial savings. Cars. Buying a car in the U.S. is often a negotiation process where knowledge and patience can save you thousands of dollars. Tips for negotiating a car purchase. Research. Use websites like Kelley Blue Book or Edmunds to determine the fair market value of the car you want to buy. Timing. Dealerships are often more willing to negotiate at the end of the month or quarter when they're trying to meet sales quotas. Consider financing. Sometimes, dealerships offer better prices if you finance through them. However, be sure to compare rates from your bank or credit union to ensure you're getting the best deal. Negotiating your salary is crucial in ensuring that you're compensated fairly for your work. In the U.S., employers often expect candidates to negotiate, so being prepared can lead to better compensation packages. Tips for salary negotiation. Research. Know the average salary for your role in your region using tools like Glassdoor or PayScale. Present your case. Highlight your achievements and the value you bring to the company to justify your salary request. Negotiate benefits. If the salary offered is non-negotiable, consider negotiating for additional benefits such as more vacation days, flexible working hours, or signing bonuses. Real estate. In the competitive U.S. real estate market, negotiation skills can make a significant difference, especially in hot markets where demand is high. Tips for negotiating real estate purchases. Understand market conditions. Know whether you're in a buyer's or seller's market. In a buyer's market, you have more leverage to negotiate. Ask for concessions. Request that the seller covers closing costs, makes necessary repairs, or includes appliances in the sale. Be prepared to walk away. If the terms aren't favorable, be ready to walk away. This often puts pressure on the seller to reconsider your offer. Practical example. Let's say you're buying a new car with a sticker price of $30,000. After researching, you find the fair price is closer to $28,000. You negotiate with the dealer, who initially resists but eventually agrees to sell the car for $28,500. By being informed and persistent, you save $1,500, which you can invest or use for other financial goals. Comparing investments: real estate versus REITs. In the U.S., real estate has long been a preferred investment, but real estate investment trusts, REITs, offer a compelling alternative that combines the benefits of real estate with the liquidity of stock markets. Traditional real estate. Investing in physical real estate, such as residential or commercial properties, is a tangible way to build wealth. However, it comes with challenges like property management, maintenance, and dealing with tenants. Advantages of traditional real estate. Control. You have direct control over the property, including decisions about improvements, renovations, and tenant selection, allowing you to potentially increase the property's value. Appreciation. Historically, real estate in the U.S. tends to appreciate over time, particularly in high-demand areas. This can lead to significant profits when you sell the property. Rental income. Owning rental properties can provide a steady stream of passive income, which can be particularly beneficial for retirees or those looking to supplement their income. Disadvantages of traditional real estate. High entry costs. Purchasing property requires significant capital for the down payment, closing costs, and potential repairs or renovations. Additionally, securing a mortgage may require strong credit and proof of income. Ongoing expenses. Property taxes, insurance, maintenance, and potential vacancies are all ongoing costs that must be managed. These can reduce the overall profitability of the investment. Management responsibilities. Owning and managing a property can be time-consuming. Unless you hire a property manager, you will need to handle tenant issues, maintenance, and potential legal challenges. REITs. REITs offer a way to invest in real estate without the need to manage physical properties. They are companies that own, operate, or finance income-generating real estate across various sectors like residential, commercial, or industrial properties. Advantages of REITs. Liquidity. Unlike traditional real estate, REITs are traded on major stock exchanges, making it easy to buy and sell shares as needed. This provides greater flexibility and quick access to cash. Diversification. Investing in a REIT gives you exposure to a diversified portfolio of properties, reducing the risk associated with owning a single property. Lower entry costs. You can start investing in REITs with much less capital than what is required for purchasing physical real estate. This makes real estate investing accessible to a broader audience. Tax benefits. REITs are required to distribute at least 90% of their taxable income to shareholders as dividends, which can be a stable source of income. Additionally, REIT dividends may qualify for a lower tax rate compared to regular income. Disadvantages of REITs. Less control. As an investor in a REIT, you do not have direct control over the management decisions or the specific properties included in the portfolio. Market volatility. REITs are subject to market fluctuations, and their value can be affected by factors such as interest rates, economic conditions, and changes in the real estate market. Tax considerations. While REIT dividends can be tax-advantaged, they are still generally taxed at a higher rate than qualified dividends from other stocks. Practical example. Suppose you have $100,000 to invest. You could use it as a down payment on a rental property, which might generate $1,000 per month in rental income after expenses. Alternatively, you could invest the $100,000 in a diversified REIT portfolio, which might yield a 5% annual dividend, providing $5,000 per year in income with the added benefit of liquidity and diversification. Depending on your financial goals and risk tolerance, REITs might offer a more flexible and diversified approach to real estate investing. Reinvestment and wealth utilization. Growing wealth while enjoying it. The concept of reinvestment is central to wealth creation in the United States. By reinvesting your earnings, You can harness the power of compound interest, accelerating the growth of your portfolio. However, it's equally important to balance reinvestment with enjoying the fruits of your labor. Reinvestment strategies. Reinvesting the returns from your investments, whether from dividends, interest, or capital gains, can significantly enhance your portfolio's growth over time. This strategy is especially powerful in the context of retirement accounts, where tax-deferred or tax-free growth can compound without the drag of annual taxes. Types of reinvestment. Dividend reinvestment plans. DRIPs. Many U.S. companies offer DRIPs, allowing you to automatically reinvest dividends to purchase more shares of the company's stock, often without paying brokerage fees. This can lead to exponential growth in your holdings over time. Bond laddering. If you invest in bonds, consider reinvesting the proceeds from maturing bonds into new bonds with varying maturities. This strategy helps manage interest rate risk and ensures a steady stream of income. Real estate profits. If you're involved in real estate, reinvesting rental income or profits from sales into additional properties can build a larger portfolio, generating even more income and capital appreciation over time. Wealth utilization. While reinvestment is key to growing wealth, it's also important to enjoy the rewards of your hard work. Wealth utilization involves strategically using your resources to enhance your quality of life without jeopardizing your financial future. Tips for utilizing wealth wisely. Create a lifestyle budget. Allocate a portion of your investment returns or savings to fund lifestyle expenses such as travel, hobbies, or entertainment. This ensures that you enjoy your wealth while staying within your financial means. Invest in experiences. Research shows that spending money on experiences, rather than material possessions, tends to bring greater happiness and satisfaction. Consider using some of your wealth to travel, learn new skills, or spend time with loved ones. Balance enjoyment and security. It's important to find a balance between spending on present enjoyment and ensuring future financial security. Regularly review your financial plan to make sure you're on track to meet your long-term goals while still enjoying life today. Practical example. Imagine you have a portfolio that generates $20,000 in dividends annually. You decide to reinvest $15,000 of that into additional shares, which will help your portfolio grow over time. The remaining $5,000 is used to fund a vacation, creating memories and experiences that enhance your quality of life. This approach allows you to build wealth while also enjoying the benefits of your investments in the present. Building wealth in the United States requires a combination of strategic planning, disciplined investing, and smart decision-making. Whether you're navigating the complexities of real estate, optimizing your investment strategy, or balancing the reinvestment of profits with enjoying life's pleasures, each step plays a critical role in your financial journey. By treating your investments like a business, considering the opportunity costs of paying off debt versus investing, and leveraging the benefits of diversification through traditional real estate or REITs, you can create a robust financial foundation. Furthermore, by carefully managing how you reinvest and utilize your wealth, you can ensure that your financial success not only secures your future, but also enhances your present. Remember, the key to long-term financial success is consistency, patience, and the willingness to adapt your strategy as your life and financial goals evolve. Whether you're just starting your financial journey or looking to optimize your existing wealth, these principles will guide you toward achieving lasting financial security and personal fulfillment.